to the question from last day that we didn't do. But I don't know if I sent the solutions. I may have not as well. Right. Right. Oh, I heard somebody come in there. Where are they? Oh, Elijah. All right, cool. Hey, afternoon, Elijah. How are you going? Yeah, good to have you on. Yeah, man. Yeah. Thanks. All right, cool. All right. So, all right. So, folks, last day we started looking at variances, right? We talked about that. We said we have variances for materials, variances for what you call it, labor as well, right? There was one question we left kind of undone, and I said you guys could do it, and let me know when I'll send you the solutions. So I have those prepped already. We lost a bit of time to this because of some technical difficulties. So what I'm thinking to do today is just to kind of get straight to what I had planned, which is the overhead variances. Let me just let in Julia. Hi, Julia. Good afternoon. How are you going? Good to see you on today. All right, good to see you on, right? I'm not going to start starting this, so you miss anything. Okay, cool. So we're going to tackle this in a couple of things, right? So I have some example stuff I pulled from my UV text that is the one that actually helped me to understand this topic a bit better. So I have that stuff on the screen now, right? So I'm going to walk you through the calculations, right? Now, just again, full disclaimer, the overhead variance is something that I never learned in secondary school at Form 6 level, and variance is not something at O level, so that wasn't even a thing, right? So at the end of the day, I don't remember it being a thing in UE, although if it was, I probably, anyway, that was like, what, 25 years ago? 22 years ago now? Yeah. And then when I went to teach in the school, it was still the Cambridge syllabus, and then I was teaching CAPE for 2 years before I left, right? So I've had to kind of try and teach myself the overhead variances, and it's never really stuck, right? So what I have here are some notes that I've been using to kind of like help myself through Chipotle animal. But this is CAPE accounting. It's math based, but it's not math per se, right? So what we're going to do, we're going to take a little read through the question. We're going to identify the variances that we have to know. I'm going to walk you through the calculations, and then I'm going to give you guys some stuff to try, right? Now, we're also going to be tackling variances on Thursday, so I kind of have everything kind of lined up already, right? Yeah, so we have questions, past paper stuff already, extracted and ready to go. Oh, I have some erasing to do here for these solutions, clearly, right? So we're going to try to work through as many of these questions as we can possibly work through. All right. But of course, to get there, right, let's start here. Okay, cool. So we're talking about the overhead variances, right? Okay. All right. Give me 1 sec. I have to switch a cord because if that's going to keep happening, that's going to be quite annoying. Should pop back up in a couple of seconds. Yeah, man. All right, lovely. We're in again now. Right. Right. So the overhead variances. Yeah, so my handwriting is not the best. And I really only have to write for math these days. So right. Okay, so we're going back here now. Right, so we assume that Sanko, so we're still using Sanko, right, has developed a direct material standard, right, of 3 pounds per finished unit at $5 per pound. During a recent period, the following activity took place. All right, so we saw this information previously, right? Direct materials purchased and used in production, 6,000 pounds at $5.10 per pound. Production completed 1,900 units. Direct labor is 2 hours at $9 per hour. So those are your standards. Sorry, no. These are the actual stuff, right? So the direct material standard is up here, and this is what actually happened down here. And they also have the, what you call it, the labor information. So in producing the 1900 finished units, direct labor incurred total 4,100 hours at $8.80 per hour or $36,080. Okay, company's direct labor variance are shown. Okay, well we did that already too, right? So we did that last Saturday. So what we will now is going to do the overhead variances, right? But hold on, let me see. Do I have stuff that I could pull? Right. So this is like from olden times, from 2020, right? So this is kind of what we did. So we did actual by actual, actual quantity by standard, and then standard quantity by standard price, right? So we brought only variances into price variance or rate variance and quantity variance or efficiency variance, right? So price and quantity, and when you put them together, they get the total variance, right? Which is really just the left side and the right side. The one in the middle allows us to split the total variance into materials and labor, right? Is it maths? So well, it is maths, but no, it's actually keep accounting, right? So we did that. We saw materials, we saw direct labor, right? So we saw some of that stuff, right? So it says, given the foregoing, we can now proceed with the calculation of overhead variances for Sanko. Assume Sanko applies overhead to products on the basis of direct labor hours. So we see something kind of happening back here from like module 2 when we talked about what you call it, overhead application rates, OARs, that kind of. Oh, here's Tony. I thought Tony can make it. Hey, Tony. Afternoon. For some reason, I thought you said you couldn't make it. Anyhow, but glad you did. Don't worry, we now kind of started going through a question here. I started late, so you didn't miss much. So good to have you on. So almost everybody here, man. Glad to see that. All right. Right. So Sanko applies overhead to products on the basis of labor hours. Right. So like we said, that kind of harkens back to stuff from OAR and activity-based costing and these things, right? But more OAR. Now, it says actual factory overhead incurred, fixed plus variable is 73. So to me, this is actual, right? Right? But what I'm gonna do, I'm gonna highlight some stuff here so we could refer to them a bit more easily when the time comes, right? Sorry. Let's do that in blue. So actual factory overhead incurred, fixed plus variable is 73,000, right? So this is fixed overhead plus variable overhead equal to, of course, total. Right? If anything is too small in your class, let me know, guys. Yeah, if I'm not looking kind of small there, right? And you could think of this item here as our actual, right? So actual quantity multiplied by actual price, right? Oh, sorry, I should have probably mentioned. So I found the overhead variances a bit more challenging because they were not as straightforward as the labor and the material variances. And I mean, even even before variances, we've always said that the most challenging aspect of the costing system is the overheads because they're not directly related to output per se. They're indirectly related. So tracking them and accounting for them can sometimes be a bit challenging, right? But I mean, we're up to the challenge. TikTok Queen 2 is currently streaming their live, so it will be there afterwards. Yes, that's correct. Okay, so that's the actual. All right. See an item in green here. Sorry, why did it do that? I don't know. Green, right. So standard variable overhead rate per direct labor hour is 7. Standard fixed overhead rate per labor hour is 10. And the budgeted fixed factory overhead for the period is 40. Right? And an estimated activity in labor hours. All right, Mari. Take that one. All right, cool. So we have some information going on there. Right? So the budgeted fixed factory overhead for the period is 40. So budgeted. All right, cool. And then estimated activity in labor hours is 4,000 hours. All right. We use 4,100, right? Okay, cool. So we have some discrepancies there. Right. I have a next note here that I forgot to put. So just do excuse me. I still kind of settling. All right. So this item here is a very important item. Sanko applies overhead superux on the basis of direct labor hours. So you know how for materials we had a price per unit, and for labor we also had a price per hour, right? For overheads, as we know, we have a OAR, and the OAR, right? The OAR, the overhead rate, right, can be thought of, right, is the cost per unit. And I'm putting that in quotation marks because it's kind of, right, for overhead. So that's like a unit cost for overheads, right? So we're applying overheads on the basis of labor hours. The OAR, based on that, is like the cost per unit, like how we would have a cost per unit or kilogram for materials and a cost per hour for labor, right? So in this case, the OAR is the cost per unit for overheads, right? I have a feeling that these two items here, right? So budgeted factory overhead estimates. So that's like that's how kind of how we could get the OAR. So is that true? So just some notes there. Now we have a couple other things to just identify before we jump into it, right? So just for the record, we have the three overhead variances. Right? So the first one is the overhead spending variance. So the spending variance is how much money you spend. So it's like a price variance, overhead spending variance. Now this variance here would be basically akin to the price variance, like what we would do on that side. And the quote unquote formula is very similar to what we would have had for that. Right? So you would have had actual quantity, sorry, by actual price. And then actual quantity by standard price. So how much the actual quantity actually cost us, and then how much that same quantity should have cost us based on the regular price. Which again, I have a strong feeling is this item here, but we'll come to that. All right. Now we have a next one, which is the variable overhead efficiency variance. So efficiency is kind of like quantity or rate variance. Right, so this one is kind of like actual quantity. So this one, because it's the rate or efficiency variance, this would kind of occupy the middle and right components, right? So this one will be like the actual quantity. Oh wait, I now understand why I had stuff laid out like that in the previous notes. Okay, hold on one second. Right, you don't have to lay out stuff like this. I just did it because it makes sense to me to lay it out like this. This is my preference. Okay, cool. This one is actual quantity by standard price minus standard quantity by standard price. Right? And then in this particular case here, SP here would be for the variable costs, variable overheads, right? And then the third overhead variance you have is the fixed overhead volume variance, which is like an efficiency variance, right? So fixed overhead volume variance, right? Which essentially is the same kind of layout like the variable overhead efficiency variance. It also occupies the middle and rightmost thing. Which sub? Yeah, no, I'm not sure what you're asking me. Or subject or keep accounting, unit 2. Right. So again, we have the same kind of setup like above. Actual quantity by standard price, then compared to standard quantity by standard price. Right. And of course, this will be replaced with the fixed, right? I'll use FXD as fixed, right? Fixed standard price for the overheads, right? And again, the overheads, the unit cost for the overheads kind of is the, what you call it, the OAR, all right? Okay, right. So these are the three items that we're going to be dealing with, okay? So we're going to set it up just like how we set up the stuff on Saturday in this kind of format here, all right? So I'm trying to make it familiar with what we know again because I'm not overly what's the word? I'm not as proficient in the overhead variances as I am in the regular variances, but I'm a teacher, so I have to make it work. I have to make sure you guys understand, right? Okay, so we're going to head up example of overhead variances. Right. Of course, what I mean by that is the calculation. Okay, so as we know, usually we would start with the price variance. And the price variance is where you compare the actual amount you spend, so actual quantity by actual price versus actual quantity by standard price. So what it was you produced, what it should have cost, right? So what you actually produced, what it actually cost, but what it should have cost. So you're comparing those two things. So again, it's a price variance, right? And in this case, we call it the spending variance, right? So just to backtrack a little bit, right? So we are dealing today with the overhead variances. It's not as straightforward as the materials and the labor variances. However, again, I tried to kind of lay it out in a way that made it similar to what we did, so that way we could kind of comprehend it a bit more easily. Because again, it still is a challenge for me, these variances, right? Okay, all right. So highlighted in the kind of blue there, actual factory overhead incurred, fixed plus variable is 73. That's your actual, all right? So we're gonna put that there. So that's 70, sorry, that's 70, right, 73,000, right? And we're gonna add some more context for that. The item in green, highlighted in green, says what? Budgeted fixed factory overhead is 40. So budgeted fixed factory overhead is usually, right, the same as actual, because remember, fixed overhead doesn't change with the level of output. All right. So you have 40,000 there. So once again, that 40,000 is this item here, which is the budgeted fixed factory overhead. And again, because fixed factory overhead doesn't usually change or vary with the level of output, usually budgeted fixed factory overhead and actual fixed factory overhead end up being the same item. All right. So that's why we could take the 73, which is total overhead, fixed and variable, and split it into fixed plus variable. Of course, variable would just be 33. All right. So, ladies and gents in Google Meet, just give me a quick G if you're good with that first stuff I wrote there. How I got the 73, the 40, and then the 33. Just give me a quick G. If you need me to re-explain, it's not a problem. Let me know. Happy to do so. Oops, sorry. 9 out of 12. All right, number. So the next 3, 4 people, let me know. Right, what you feel. Okay. Okay, so now we are working out the overhead spending variance, right? That's the first thing, right? The overhead spending variance. So we're comparing actual expenditure to what it was supposed to be. So as you can probably guess, since fixed probably stay the same, the variable is where we have to kind of focus on. All right. Now, with this next one for actual quantity by standard price, right? So again, we're looking into fixed plus variable, right? Now, of course, the fixed is still the 40, right? That didn't change, right? But what changed? So what we have to figure out now is this piece here, right? We need to figure out, hey, how much should we spend on variable overheads? Let's go back for a second. So remember, with overheads, right? With overheads, find overhead that we apply, we have to take the OAR and multiply it by the actual volume of the cost driver. Remember, they told us up in the yellow at the very, almost at the very top there, assume Sanko applies overheads to products on the basis of direct labor hours. Okay, so we know that our cost driver, our cost driver, come on, man, Philip, yourself. All right, our cost driver is direct labor hours, right? Now, what else they did was they actually gave us, so I didn't put it in a color, but it's the second bullet point. So I'm just going to circle in orange. Sorry, that's not orange. Okay, right here. So that one there, all right? So that is the standard variable overhead rate per direct labor hour. And they also told us that they actually incurred 4,100 direct labor hours, all right? So on this side now, we're going to take the OAR, which is the $7 per direct labor hour, and multiply it by 4,100 direct labor hours. Right? So now the 40,000 just kind of comes down, and 7 by 4,100 is 28,700, I believe. If my arithmetic is wrong, please feel free to let me know. So 28,700. When we add them together, we are going to get 68,700, right? So of course now, when we are comparing the actual with what the actual was supposed to be based on the standard cost, what we're seeing is we actually spend more than we were supposed to, right? So now let's put them together, right? So if we compare the 73,000, right, with the 68,700, what we're going to get is 4,300. Sorry, I should have put dollar signs, right? 4,300. And it's unfavorable because we actually spent more than we were supposed to. So let me recap that, right? So the first, actually, let me push this down. I don't know why I didn't head it up. Right? So we're going to tackle first the overhead spending variance. Right? So this is the overhead version of the price variance, overhead spending variance. Right? Right? And again, you could think, oh, sorry, I did just, what do you call it? Reduce the weight, right? So you could think of it like a price variance for the overheads. So, but it's spending, so you're looking at the actual amount incurred and spent, right? So again, what we have to compare is the actual amount spent on overheads and the amount that should have been spent based on our standard cost, right? And the standard cost is the OAR. So to find actual, when we read the question, that's there in the kind of blue highlight in there, right? Actual factory overhead incurred, fixed plus variable is 73,000. And in the green 2 lines below, or 3 lines, the third line below that, we're seeing that budgeted fixed factory overhead for the period is usually, it's 40,000, right? Right? And so usually budgeted is equal to actual for fixed costs. There's a note worth taking, fixed costs. All right. Just started learning it. Oh, nice. So you kind of build on that. Lovely. Right. So the 73,000 is the total, out of which 40 is fixed. So what we do is we analyze that, right? 40 and 33 will give us back 73. Now we have to compare that to the actual quantity at the standard price. So how much this actual quantity should have cost, right? Now again, we're splitting this item here, which is a dollar figure, into fixed and variable because we're dealing with overheads, all right? So the fixed overheads, right, just it was given to us. Any question, we use it as it is. Variable, that's where the OAR comes into play. So as we know, for overheads, we take the OAR, the rate, and multiply by the actual volume of the cost driver, right? So the OAR, now, normally we'd have to calculate that by taking the, what you call it, the estimated overhead and dividing by the estimated activity, which it was 4, but the 40 above it was just for the fixed. They didn't give us an estimate of variable, did they? No. Right, but they did give us in the line just below the blue highlighting, so the second bullet point, it's the standard variable OAR, which is per direct labor hour, is $7. So that is your OAR. So that's your $7 here, and the actual volume of the cost driver. So they told us on the top right-hand side that the direct labor incurred total 4,100 hours. That's how many labor hours you have to multiply by to apply the overheads. 41 by 7 is 28,700. I'm going to add it to 40,000, you get 68,700. So this 68,700, sorry, right, is the middle term. How much our actual output was supposed to cost, right? Now it actually cost 73. It was supposed to go 68,700. So clearly we have an unfavorable variance. We spent more than we should have. All right. Yeah. Okay. Cool. Right, so this is actual quantity by actual price compared to actual quantity by standard price. Right, and again, because it's overheads, you have to break it up into fixed and variable. Okay. So can I get a G in the chat if you guys are good with what I did on the screen there? If you need me to go over it again, that's not a problem. Just let me know, and I'll organize. All right. You could always send me questions via WhatsApp if you prefer to send them there. Okay, cool. Okay, thank you. Lovely. Let's go. All right. I can't, but I get what you were doing. Okay. Right. So that is the spending or price variance of the overheads. Right. Now for the efficiency variance or the quantity variance, right? That's where we have to analyze, I guess, output levels, right? The direct labor hours, that kind of stuff, right? So we have to do it in 2 stages. Let me explain why once again. Sorry, hold on. I have enough room here. Yeah, man, I have enough. Right. Cool. Right. So we have the variable overhead efficiency variance and the fixed overhead volume variance, right? So both of those in this case, sorry, are both efficiency variances. So what's going to happen? We're going to have 2 sets of efficiency to analyze, and then we're going to combine them together in addition to the spending variance that we just did, right? But again, let's just take one thing at a time, right? Let's just put a little separator line here. All right. So I'm just going to box these things off because I'm going to put the corresponding items just below here, right? Okay, cool. So in this case, we're doing the variable overhead efficiency variance. Right. So we take in actual quantity by standard price and then standard quantity by standard price. So what does that mean for our variances? you do you? I do. I have a very interesting YouTube channel for CSEC PUA mainly, but you'll find some of my lives for what you call it, keep there, right? Okay, so actual quantity by standard price and standard quantity by standard price, right? So we saw in the working above this item here, actual quantity was 4,100 direct labor hours. And the standard price again is the OAR. And as the question said, sorry, my bad, just below the blue line, the second bullet point, standard variable OAR was $7, right? So multiply by $7 per direct labor hour, right? So that's 28,700. Right. So we kind of already had that piece up here. Right. Now, what about the standard quantity and standard price? Okay. So the standard price piece we already knew. What is the standard quantity? Well, the actual quantity was 4,100 direct labor hours. So the standard quantity will be the standard labor hours for the current level of production. So the standard labor hours for the current level of production. So in producing, hold on. Sorry, one sec. I don't know why that keeps popping up. Yeah. So in producing 1,900 finished units, right? And normally direct labor standard is 2 hours per unit, right? Hold on, sorry, one sec. Right. So the standard is 2 hours per unit, and we made 1,900 units, right? So now, if you consider that 1,900 by 2, we get 3,800. That's the direct labor hours that we should have used for this level of production. And we multiply that by the same standard price of $7 per direct labor hour. 26, I believe, right? That's 26,600. So once again, just to recap, we're doing the variable overhead efficiency variance, right? So what we're looking to track here is like the efficiency variance for variable overheads, right? So that has to do with quantities used, right? Now, again, overheads is one of the more difficult ones to explain because they're not as direct and easily traceable as materials and labor. Those ones, it was just that it was a lot at the same time, but each one was kind of clear, kind of understandable, hopefully, right? This one, in my opinion, not as. If you find it easy, great. I do feel like I'm doing a good job today, to be honest. I feel kind of like I walk in one step at a time in the dark, hoping I don't put my head, right? But anyhow, right? So once again, the variable overhead efficiency variance is the efficiency variance for the overheads, specifically variable, right? With the previous stuff we did on Saturday, right? That was this. We were comparing actual quantity and standard quantity, right? Because the efficiency variance is with quantities used, right? Now, when we're talking about overheads, right? Remember, they were telling us that we're using in the yellow, Sanko applies overheads on the basis of direct labor hours. Okay, cool. So they actually use 4,100 labor hours. But normally, right, they use 2 hours per unit and they made 1,900 units, right? So 1,900 by 2 is 3,800. So that is how many labor hours we were supposed to use to make 1,900 units. We were supposed to use 3,800. We ended up using 4,100. So clearly we're going to have an adverse variance. And of course, in each case, you have to multiply by standard price. What's the standard price? The standard price is the OAR. And according to the question, as the item circled in orange down here, right? The variable overhead OAR or rate is $7 per direct labor hour. Right. So 4,100 by 7 is 28,700. 3,800 by 7 is 26,600. So now, when we compare those two, right? So we have 28,700 minus 26. So we spent more than we were supposed to. So that's equal to $2,100 unfavorable. Yo. Yeah. Okay. All right. We put you. He coming out early. I have accounts before, right? I don't remember if Kayla have a class tomorrow. She's coming later. I'll ask her. Okay. Right. Worst case scenario, yeah, you could check up in on corner, so I shouldn't be a problem. All right. Thanks so much, Chris. Yeah. All right. But I'll give it for today and yesterday one time, right? So yes. Yeah. Good here, right? Yeah. Well, I hope it clears up so you could see your friend. I know you. All right. Okay. So Google Meet. If you guys are good with the variable overhead efficiency variance as explained, just kindly give me a quick Q&A chat, please, and thanks. Right. If you need me to go with it again, it's not a problem. I will. I might help myself too. All right. Yeah, Jose. Well, happy to have man. All right. So right. Okay. Yeah. If you find you're having little issues with this one, don't worry. I still have issues with it too. 1, 2, 3, 4, 5, 6, 7, 8. All right, cool. So 8 out of 13. All right, a little more than half. Not the best, but not bad. Okay, let's put a next line there. Right. So now what we're going to do is the third variance, and the third variance is the fixed overhead volume variance, right? Okay, 9. Fixed overhead volume variance. Oh. Okay. All right. So the person who sent me the WhatsApp saying they have to leave, not a problem. You do your thing. All right. But send me a reminder about that stuff you wanted. All right. Anyhow, okay, right. Okay, so basically what we're going to do now is the fixed overhead version of what we just did for the variable overheads. All right. Now, let's just head up the little calculation things. Now, these are just placeholders for me for right now because they kind of keep me grounded in the pattern I had established, or we had established rather, when we did the materials and labor variances, right? So, actual quantity and standard price. Now, with fixed overhead, remember, budgeted and actual fixed overheads are usually the same because fixed overheads don't increase with the level of output, of course, within the relevant range. So once you do surpass the capacity of the plant or the factory or what have you, your fixed overheads remain fixed, regardless of if you produce more or less than you planned to, right? Again, within the relevant range. Now, the fixed overheads, as we saw across here, as a green, right? The budgeted fixed overheads was 40,000, right? So that'll just give us this figure in the middle here, right? 40, 1, 2, 3. Now, for standard quantity by standard price, it's actually going to be very, very similar to what we just did for the in the purple. Because if we look at the, so I guess I have to put this in a purple too. I guess I'll use red, right? Actually, that's a little too close to that. I'm sure what color to use. Let me use blue. Right? That didn't come out good, right? Okay, yeah. So the standard fixed overhead rate per DLH is $10. So the only thing that's going to differ between the working we just did and the working we actually doing is as follows. We're just going to be changing the rate. That's all. Right? Yeah. So the standard quantity of the labor hours. So remember, the standard quantity of labor hours, right? Because that's how we apply overheads. They apply based on the number of direct labor hours. So again, it's the same 1900 units by 2 hours per unit. That's 3800 direct labor hours. We're multiplying it now by $10 per direct labor hour. That's going to give us $38,000. Cool. And now all we're doing is we're comparing 40 and the 38. So clearly, actual overheads right? Versus, well, this isn't even budgeted, right? Remember the 40 was budgeted and actual, right? So here now, this gives us a 2000, but unfavorable, right? So what that means is that, so that's the kind of weird part and why like these variances don't really click with me per se, is that this don't really have any basis in the question. Like we budgeted 40,000, we actually incurred, well, and that's probably what we paid, right? They didn't tell us any different across here, right? But basically what we did is when we calculated this piece here, right? We use 1900 hours to make the units, right? And that cost us 3,800 direct, sorry, 1900 units, and that was 3,800 hours, right? Whereas normally, what would it cost us, boy? No, sorry, it was actually 41. So 3,800 was the budget, right? So you see, this is where I get confused, right? So let me backtrack a little bit. Cool, right? So again, we're doing standard, right? So sorry, I hope I didn't confuse anybody, right? So again, we're using standard, right? So the standard quantity by standard price. So again, for the fixed overheads, it was $10 now, right? And the standard quantity of labor hours, right? So we actually used 4,100 labor hours, but the standard quantity was 38 because it was 2 hours as the standard, and we actually did 1,900 units. That'll give us 3,800 DLH, right? So 3,800 by 10 is 38,000, comparing that to the actual overheads. Right? So yeah, that's the fixed overhead volume variance, that one there. Right. So now, total overhead variances, right? Overhead variance, sorry, not variances, my bad. Right, so you start from top. Now they were all unfavorable, right? So we have 4,300, top left hand side there, then 2,100, and then 2,000, right? Favorable. Right, so that's 41, and that's 8,400 unfavorable. All right, cool. Right, so again, just a recap before I give you guys one to try, right? And again, I'll see if I can still kind of walk through with you because I don't feel like I did that great a job explaining stuff. Sure. Right. So just to kind of bring it back from top, right? So when we are doing overhead variances, you have three. You have your overhead spending variance, which is like our price variance. So that's how much money you actually spent. This is how much you should have spent, right? Then you have your two efficiency variances. For the variable overhead, we call that the efficiency variance. But for the fixed overhead, it's called a volume variance, because I think it's the volume of capacity you use or something like that. Yeah, I never understood the explanation there. Anyhow, right. But long story short, we can calculate. Even if we don't understand what it is, we could calculate it, right? So again, that kind of goes against my usual ethics of understanding what you're doing before you do it. But sometimes you had to just figure out how to do it and then figure out what it means after. Anyhow, so going from top. So it says in the yellow, right? So Sanko applies overhead to products on the basis of direct labor hours. So the note I have there is that that's the OAR, right? And the OAR is basically the cost per unit for the overheads. And in the bullet points that follow, the second and third ones, the ones that are not highlighted, you have a separate overhead rate for direct labor hours for variable overheads and then fixed overheads. So you have a slightly smaller rate, $7 per direct labor hour for variable overhead and $10 per direct labor hour for fixed overheads. All right. So for the spending variance, again, we're looking at the actual versus what we should have. Now, the item in blue in the first bullet point has the actual factory overhead incurred, fixed plus variable 73. And just a couple ones below in green, the budgeted fixed factory overhead is $40,000. Now, again, budgeted fixed factory overhead usually ends up being actual fixed factory overhead because we usually know the fixed overheads beforehand. And again, once you are within the relevant range, the fixed overheads stay fixed. Cool. So what we do is we are analyzing, we take the 73, which is the total, and we break it up into fixed and variable. So fixed is 40 because they gave it to us. And the 33, well, 73 minus 40 is equal to 33, right? So that's the actual, the actual part. We want in the middle how much it should have cost, right? So again, we're going to break up the overheads into fixed and variable. So the fixed stays at 40. The variable, right? So that's where we come into, that's where our usual thing comes into play. The OAR multiplied by the actual level of the cost driver. So for variable overheads, it was again $7 per hour, and the actual direct labor hours was 4,100, right? So 4,100 by 7 is 28.7, and when you add it to 40, you get 68.7, right? But still, when we compare that 68.7 to the 73 we actually incurred, we found, hey, well, we actually spent more than we were supposed to, all right? So it seems that the variable overhead is the culprit there, because we were supposed to incur 28.7, but we incurred 33. We don't know why, but again, that's the variance calculation is the starting point. The analysis is where you dig into it and find out why, right? So the spending of price variance is that, right? Again, as you can see, it is different from the regular materials and labor variances, because with those, you didn't have to worry about fixed and variable. They were all variable, right? So the fixed overhead is kind of what's throwing it off here, I guess you could say, right? Right, now, that's the spending variance or the price variance, right? For the efficiency variance, right? So again, that's the two in the middle, actual quantity by standard price and standard quantity by standard price. So we have one calculation for variable and one for fixed, right? So for variable, right, actual quantity by standard price. So again, the standard price, the price of the overheads is the OAR, right? Standard price is the OAR, which turns out to be $7 per direct labor hour for variable. Actual quantity, well, what are we talking about? Well, again, what is the basis upon which we are applying overheads? Direct labor hours, right? That's the part in the yellow. And how many direct labor hours we actually use? 4,100. 4,100 by 7 is the same 28.7. Now, again, that was already gotten on top of here. So you could just pull it from there, right? Now, the slightly more interesting thing, as you, Mishka, how did that be? Slightly more interesting one is the standard, right? How much we're supposed to actually be used, right? Now, just give me 1 second, let me show, right? All right, Josiah. Well, tomorrow for regular math, right? Okay, cool. Later. Okay, sorry, right. So now, for this piece here, so we saw the standard price is the same $7. But what is the standard quantity? Well, we're talking about the quantity of labor hours. That is the basis upon which we are applying the overheads, right? So for the standard quantity, we have to go and take a look at the number of units, right? And the number of hours that we're normally supposed to take per unit. 1900 by 2 is 3800. So 3800 compared to 4100 is less. What that means is that we actually use more labor hours. So we definitely know we're going to have an adverse or unfavorable variance. When you multiply it out, you want? Okay, well, I hope you feel better. Don't forget, right? So that's for Monday and today, right? Okay, cool. Thank you so much, guys. Yeah, no problems. I'll see you tomorrow then. Tomorrow, yeah. Later. Right, okay, good. Page, that's you. My class? Yeah, guys. So standard quantity of hours, right? Because again, remember, unlike the materials and labor, right, which are directly related to output. So you could have a quantity of materials you're using, you could have a quantity of labor in terms of hours. With overheads, it's almost like it's kind of ethereal. What are we using? What is the quantity of overheads? Because overheads is like a whole kind of cost pool of different costs, right? You have so many different things that could go inside of there, right? So what is the quantity we're using? And again, we're applying overheads based on, in this case, direct labor hours. That could change, right? But of course, this is just the example, so we're keeping it simple. So the standard quantity, as the question showed, was the 1900 units actual, but it was supposed to be at 2 hours per unit, right? That's the standard, so 3,800, right? So 1900 by 2 is 3,800. Then by 7, the standard cost gives us 26,600, right? From there, now we compare to 28,700, the actual value, right? And of course, that is higher than the standard value, so we have an unfavorable variance, right? And the final piece of the puzzle here, which is the fixed overhead volume variance. So again, it's an efficiency variance. So we're using these two items, these two products here, to compare the standard price of the actual quantity and the standard price of the standard quantity. So how much it should have cost, right, to get the actual output, and how much the output was supposed to be, right? Well, not output, but the quantity, right? So again, with the fixed overheads, right, there's no calculation usually necessary because they usually give you the fixed overhead value, right? Be budgeted or actual in every cases, right? And again, normally budget is equal to actual, right? Okay. Now, for this one here, standard quantity by standard price, it's the same 1900 by 2 because it's still overheads. It's still how many direct labor hours, but now it's $10 per labor hour, right? Okay. So 1,300 by 10 is 38,000 compared to the 40,000, sorry. They have a 2,000 overage, right? So that's also an unfavorable variance. So then we put it all together. In this case, we happen to have all three variances unfavorable, which is not going to happen all the time. At least I don't think it should. And in that case, we have an overall unfavorable variance of the overheads, right? Okay. So I'm not talking a bit long with that because once again, like I said, I'm not as clear on it as I am with the other one. So it's take a little more doing on my part. All right. So if you guys are good with the, well, what I have on the screen here, including the part you currently see right now, let's give me a quick G, please and thanks. Right. If you need me to go over it again, and again, not a problem, I will. Right. What I do actually want to do, I want to actually go to the next question. So we have some fresh stuff to work with. And we can kind of go through and see how we can pick apart this stuff and make it make sense. Cool. Lovely. Thank you. Sorry, who's this? Uh-huh. Oh, it's the same message as Sarah. I said, no problem. Fine. Okay. Hey Joshua, in Form 1, yeah, well, this is Form 6 stuff, so I can be up your alley just yet. But welcome to stay and check it out. All right, guys, so let's go to the next page. All right, so Nova Manufacturing applies factory overhead to products on the basis of direct labor hours. Hold on one second. Huh? Right. So let's just highlight that. So we have the information kind of readily available to us, right? So they apply factory overhead to products on the basis of direct labor hours. Right? Okay, cool. Next. At the beginning of the current year, the company's accountant made the following projections of the upcoming period. Okay. So I'm seeing it says estimated variable overhead 500,000. That's the first one there. Right? Estimated fixed overhead 400,000. And estimated direct labor hours, sorry, that's supposed to be in blue. Okay, maybe I need to take a slightly heavier point. All right, cool. So we have estimated overheads. So from each of those, right, we could actually work out the OAR for each one. Because remember in the previous question, we had a separate OAR for variable and fixed. So you know what? Let's do that. Let's do that now. All right. So what I want you to do is I want you to, 1 second, yeah. Don't know where I got arrow. So I want you to work out the variable overhead application rate here, right? And then I want you to work out the fixed overhead application rate. Well, you don't have to work it out there, but that's where I will put it, right? So again, all you're doing is taking the overhead and dividing by the number of labor hours. So let's start there. All right. Give it the rest of the minutes. All right, cool. So for the variable overhead, for the variable OAR, we'll take the $500,000 and divide by the 40,000 direct labor hours. That's going to give us, I think, $1,250. All right, so you have $1,250 per direct labor hour for variable overhead. So that's like your standard price for your variable overheads, right? So like that's like your standard price, right, for your variable. Right? You don't have to notate that. That's just me being mathy, right? Right. And then for the fixed one, you're gonna take is 400,000 now divided by 40,000, right? So that's just gonna be $10 per hour. Yeah. All right. So this again is like a standard price for your fixed overheads. Okay. Cool. Now let's continue reading because we didn't finish read the question, right? Just kind of stopped in the middle there to get some information. Right. Okay. It is now 12 months later, apparently. Okay. Actual total overhead incurred in the manufacture of 7,900 units amounted to 895,500. Okay, hold on. That's a lot. Let me kind of unpack that, right? I just need a different color, right? Total overhead incurred in the manufacture of 7,900 units amounted to 895,100. So 895,100 is the actual overhead, right? Now they didn't say, as you can see, is only like one sentence or two sentences after that. They didn't say anything about having a different value for fixed overhead. So the fixed overhead is probably still 400,000. And if you subtract 400 from 895, you get 495, which is less than the 500. So we've seen a favorable variance coming up. But anyhow, I kind of jumped in the gun. Sorry about that. All right. Now, it goes on to say that actual labor hours total 39.8. All right, now it says assuming a direct labor hour standard of what? Huh? Oh, okay. Yeah, I'll do this one, right? So assuming a direct labor standard of 5 hours per finished unit, calculate the following. So the variable overhead efficiency variance, fixed overhead volume variance, overhead spending. Okay, well they're asking a kind of outer sequence of how I want to do it, right? Because I kind of want to follow the pattern that we established before. I don't want to kind of have it all over the place, right? So we actually gonna do part C first, right? But before we do part C first, let's just talk about a couple of little things here, right? Right. So actual overhead incurred is 895 one. So we said out of that 895, 400 is fixed, which means the rest is variable. And just a little quick maths, 400 from 895 is 495, which is less than this. So your variable overhead, your spending variance might be positive, right? Probably going to be positive. Favorable. Sorry, I keep saying positive. We made 7,900 units, and the labor standard is 5 hours per unit, right? So I think that's 39,500, right? So if you take 7,900 and multiply it by 5, you get 39,500, right? Okay. And we actually use 39,800. So we use more labor hours than we were supposed to, 39,500 direct labor hours, right? That was equal to the 7,900 units multiplied by the 5 direct labor hours per unit, right? Okay. So we also see that we use more labor hours, so that's probably going to jack up an efficiency variance, right? Yeah, okay, cool. So what we want to do is we actually want to do it not in the sequence that they're asking for it there. We want to do it in our sequence, right? Now, if you feel like you want to deviate from the plan and do your own thing, all well and good, right? I'm going to start with the overhead spending variance, right? So overhead spending variance, right? So again, I'll just kind of start you off, right? So again, normally this would be, if it was like the materials or labor for the price variance or the rate variance, it would be actual quantity by actual price. Now, in terms of the overheads, that's the 895, right? And we're comparing it to actual quantity by standard price. Remember, you're splitting it up into fixed and variable, right? So what I want to do is I wanna send this in the chat. Right, as your template, I guess you could say. Wait, did I take the whole thing? Yeah, I did. All right, cool. Right. And then I'm gonna send this one as well. So you could always pull it up in the chat and take a look and see what's going on there. Right. Okay. I'm gonna go back to the page 3 here. Right. So for the actual overheads, like I said, it was 895, right? 895 one, my bad. You want to split that into fixed and variable. And you want to also do the same thing for, sorry, where's the 5 from? They give that the 5 to us here. Yeah. So I'll give it a couple minutes, see what we come up with. problem. All right, let's go. Right. So again, um, just for the sake of illustration and getting the thought process in order, we want to split this up into, yeah, fixed overhead plus variable, right? So fixed overhead was 400,000. That's the item under the second bullet point from the top there, underlined in green, right? $400,000. So out of 895, 400,000 is fixed, which means the remainder, which is 495, 100, is variable. Okay, cool. Now, what about this part here with the actual quantity by standard price? So again, we're going to split this into fixed and variable, right? The actual quantity for the fixed, right? Again, that's still just 400,000, right? Variable, right? So that's where our usual calculation for overheads of OAR, OAR multiplied by the actual quantity of the application base comes in. And that's the part highlighted in blue. Now remember, it said at the top there in yellow, they apply factory overhead on the basis of direct labor hours. Sorry, keep one, keep one live. Ordinary shares. Soul, message me on Instagram or TikTok or WhatsApp and email me. See if I can help you out there because we had a crash course going on and I think it's finishing next 2 days. We're doing shares today, but message me. I think I have some replays available. Right, sorry. Right. So again, that's where we're using our usual thing of the OAR multiplied by the volume, the actual volume of the cost driver, right? Now, the item in blue is the actual labor hours, and we're using labor hours because in the yellow it says they're applying factory overhead on the basis of labor hours, right? So the OAR for the variable overheads is the pink 1250, and we're multiplying that by 39,008, right? So $12.50 per direct labor hour multiplied by 39,800 direct labor hours. All right, so that's equal to 400,000 plus 1250 by 39,008. 497,500. So actually, if you look at it, 497.5 compared to the 495 one is actually more by about $2,400, right? So the total you get here is actually 897,500. You're comparing that to that, right? So sorry, sometimes the arrows are kind of sometimes I'm not sure. Right. So the actual was 895,100. The standard actual, how much that was supposed to cost instead of what it actually was, 897.5. Right. Now that's going to give us $2,400 difference, right? And a favorable one because we spent less than we actually spent less. We actually spent less than we had budgeted. Right? We spend less actually than we planned. Okay. Ladies and gents in Google Meet, if you guys are good with that, just kindly give me a quick Genie chat. If you need me to re-explain, it's not a problem. I'm happy to do so because I know this thing could be a little tricky. If you're good, cool. Out of 11. So people dropping out their way. I got frightening people away, way pressure. Hope not. Okay, cool. So that was the overhead spending variance. The next thing I want to tackle is the variable overhead efficiency variance. So we're going to go to item A, right? I'm going to do A now. So item A is the variable overhead efficiency variance, right? Now that would be like the middle and the right side. Right. So just a quick look back at the item here, right? So for the variable overhead efficiency variance, we actually found that figure when we were doing the overhead spend variance, right? So for this one, we actually have it already. We actually have the 497.5 already, right? But for the standard, by standard, right, what is the standard? So the standard price is the same 1250 as here. The standard quantity is the standard quantity of labor hours that was supposed to be used for this volume of production. So we finished 7,900 units, right? Oh, and it's a standard of 5 hours. Sorry. I'm looking and I wasn't seeing no, because they put it in words as opposed to numbers. That's what happened. I'm looking for a number whole time. So you see why it's important to read carefully. All right. So yeah, so that 7,900 by the 5, that will give you your standard quantity of labor hours that this was supposed to take. Right? So I figure out how to yeah, I guess I could just do this. All right, okay. Anything else above? No. Okay, cool. So right there. Okay. So I want you to do this part for me, the variable overhead efficiency variable. Hi, evening, Shamo. No boy, it have no actually also was a message. Mishka actually came down with a very bad headache. So she can't do class today. Yeah, I got a message, but yeah, but I was I currently in a next class now. But as I mentioned earlier, I'm gonna WhatsApp everybody one time. Yeah, so sorry, no class today. A good thing he messaged me, boy. I forgot I was supposed to. Sorry, just give me 1 second. Let me message my people. All right, cool. Let's go here, guys. All right, so we want to do the variable overhead efficiency variance, right? Now, like I was saying, um, we kind of already have the middle figure here because we had to use that on top of here, right? So the actual quantity by standard price, so the actual quantity of what? What are we applying overheads on the basis of? On the basis of direct labor hours. We actually incurred 39,800 direct labor hours. So that's 39,800. In this case, multiplied by 1250, right? All right, cool. And that will give us the same 497,500. Right. What about standard quantity by standard price? Let me see if I can actually shrink this down a little bit. Still quite legible. I think it's perfectly fine. Right. Standard quantity by standard. So standard quantity of what? Of labor hours. And the standard price is 1250, right? Right, but what is the standard quantity of labor hours? Well, again, go back to the question. We produced in the green, right, 7,900 units. And then the standard labor hours per unit is 5. So we have to multiply 7,900 by 5 to find the standard quantity of labor. So that's 7,900 by 5, 39,005. Right, and then 39,500 by 1250. Right, so yeah, so here. 493,750. Right? So we actually spent more than we were supposed to. Right. So, sorry, one sec. 497, 500 minus the 493, 750. That's a 4. 1? No, 3. That's a 6. Oh, wow. Okay, cool. Right. So what's going to happen is we're going to get a 3750 variance, which is unfavorable. Okay, cool. That's that one. And the last thing we have to do now is the fixed overhead volume variance. Again, using the same kind of setup as above here, actual quantity by standard price, standard quantity by standard price across here, right? Now, again, if you compare it to what we did before, right? So the fixed overhead volume variance, right? It just pulled the fixed costs, right? And across here, it was basically the same setup as on top of here, right? The same quantity here, but of course the rate differed. We have our rate that we calculated above. It's $10, right? That's the green one, that's the 10. Right? And the fixed overheads is 400,000. All right, so I'll just kind of scroll up here so you can see the information in the question. I'll give you a couple minutes. We'll pop it in, correct it, and then move on from there. Oh, all right, guys. Right. So, like I was saying, the actual overhead, sorry, the estimated fixed overhead and the actual fixed probably the same, right? So that one is just a simple 400,000, right? This same figure, 39.5, right? Because that's the standard quantity of direct labor hours used, right? 39,500. But the rate now is $10. So that's going to give us 395,000. Right? When we compare the two of them, right? That's 400,000 minus 395. Why don't it go in? It go in. Yeah. All right. Doing some overhead variances here. Yeah. All right. Later. Right. Now, because the actual is greater than the standard, we're going to have an unfavorable variance, right? Okay. And then the final thing we have to do, so let's just circle up our major figures there. Final thing we have to do is just add them together to get total overhead variances. So just do that quickly for me, and then we'll do that. Yeah, no problem, Trunika. That's fine. All right, so we have basically 8750 unfavorable and then 24. So hold on, let me just make sure I have enough room here. Oh, okay, that's fine. Right, so total overhead variance is equal to 2400 favorable plus, well, 3750 unfavorable plus, sorry, 5000 unfavorable. So that's going to give us 6350. Yeah, yeah. So 6350 unfavorable. Cool. All right. Okay. So, ladies and gents, that's about it for today. All right. When we come on Thursday, we're going to be. I have as you can see, a bunch of other questions already kind of prepped here. It's just to do them. Right. So we'll do as many as we can. But like I was saying before we run off there, let me just open back up my schedule so we know what we're doing and when and what else might happen down the road, right? All right. So once again, we are here on the 15th, right? Our next class is the 17th, so that's our last day of variances, right? Okay. And then of course we have two classes next week. So I'm proposing to do what you call it, start capital budgeting or investment appraisal here, do it here, and I don't know if you all will be able to do a class on Tuesday when school starts back. If not, we'll push it to the Saturday. I was kind of hoping to have that Saturday a little clearer, so I could just kind of prep for the week. But if not, we could do it the Saturday instead of the Tuesday. I'm thinking to Tuesday because what I'm thinking as well is I put a little poll on Instagram, and some people were interested in a kind of Cape crash course of past paper questions. So if I'm doing that, what I'll do is I think I might do 6 days. So like Monday, Tuesday, Wednesday, Thursday, Friday, Saturday. But I'm not 100% sure at this point in time, right? Because as you can see, it kind of I'm gonna have 4 straight days there where we're working from 10 to 8:30 again. Well, 5 if you count the Wednesday, and technically speaking, the Monday as well. So that whole week, I can't do myself that whole week. That's just too much, right? So what I might do is because my idea was just to basically do as many paper 2 questions. So like okay, so Monday and Tuesday would have been question 1 only, right? So that's what 8 hours of question 1s, right? So we would definitely do a whole lot in 8 hours. I think it might be overkill. So I might cut it down to half of that, right? So because in Monday, Tuesday, Wednesday, I could probably take on doing that, and then the rest of the week, yeah, because your exam is the following Friday, right? And as we said before, we're a bit of a clash. So I don't want to leave you all high and dry. I want to make sure we cover everything and do a little extra, right? So we'll see how best we could fit it in, right? Anyway, guys, I'm open to suggestions with respect to, like I said, if we could probably finish the syllabus by next week. And if you have any suggestions as to how y'all want to get the extra sessions in between then and that next week there, I'm very much open to it. Anyway, guys, that's about it for me. I'll see you guys on Thursday. Have a good evening. Bye.